Welcome back. Marketing platform Klaviyo just filed to go public earlier this hour. Another little sign of life for the tech IPO space as we stay on the lookout for Instacart's filing today. Joining me to discuss Axios' Dan Primack and our very own Deirdre Bosa. Welcome to both of you. Deirdre, we want to talk Instacart, but any significance on this Klaviyo filing?
I think there is, because if this was a company that was going public, it's a software company. It helps marketers. It would be an impressive one. It would probably go public at or around or even above its last private market valuation of about $9.5 billion. I mean, for a software company, it looks good. Revenue growth rate of nearly 60%, net revenue retention rate of 119%. It's narrowing losses. But this is 2023, right? And we've seen a lot of the darlings of that IPO class of 2021 trade well below their peaks. So I think all of this, and this will be a good question for Instacart as well. Where's the valuation going to land here? Instacart, in its last private round, was valued at $39 billion. It has internally marked it down to about $13 billion. So when we see those financials, does that even justify a $13 billion valuation in this environment? That's key for these IPOs and anything that's in the pipeline that's going to be looking really closely at how investors receive these financials.
And Dan, anything else you'd add?
No, I think she got it right. I will say with Klaviyo, one thing that's interesting, unlike Instacart, I think you have a lot of other companies in the pipeline who are going to look at Klaviyo and think a little bit, oh, we look a bit like them. Obviously, slightly different end users, et cetera. But Instacart is a little bit more of a standalone. You don't have a huge number of logistics delivery companies waiting. So I think Klaviyo, Instacart's the buzzier name, but I think Klaviyo might have a little bit more tailwind behind it.
Finally, one that gets Dan saying, hey, maybe we're getting back to the, normal. What is normal? I mean, we've gone from like a crazy boom to a winter, tech winter, Deirdre. Tell me about the economics behind Instacart. Are they improving?
Well, this is an interesting question. I'm dying to know. I want to dig into this S1 and look at these financials. Here's what we have heard. What we think we know is that this isn't your typical gig economy company. We know that the markets don't really like those. Uber and DoorDash are trading below their IPO prices, and investors are really asking, are these good, sustainable businesses? The unit economics, they're improving, but these companies are still losing money. Instacart may be different in that it may be profitable, and it has what we think is a substantial advertising business where the margins are a lot better. The company would probably like us to think of that as sort of its AWS. The way that AWS is the profit engine for Amazon. It pays for all of their money-losing businesses like its core, e-commerce. We know that grocery delivery is not a great business in terms of profitability. Advertising is. So that dynamic is going to be really, really important here. And expectations are that it's going to make it look better than an Uber or DoorDash.
Dan?
Yeah, I think one of the big differences between, say, a DoorDash and Instacart, and again, Deirdre's right, we need to see the S1, is that their average order size, their basket, as you will, is bigger, right? Even if you do a takeout for, 2 or even 4 people, your grocery bill is probably bigger. And I think most of Instacart will say kind of most of its orders are, they call it large basket. I think they say that's over $75. And my understanding, at least, is that the economics for them, the bigger the basket, the better that comes in profitability. So that's at least what they're probably going to argue is their big difference against some of their peers.
Deirdre?
Yeah, I would totally agree with that. That's something that you hear, and that's why Uber and DoorDash are moving into the grocery delivery business, because they want to get those bigger baskets. They want those better unit economics. But I would say we're talking about Uber and DoorDash. Those aren't the only players that we have to look out for. We need to look out for Walmart and Target, who are grocery behemoths that are doing their own grocery delivery as well. So a few years ago, Instacart was kind of the big name in this game. I mean, the big name in grocery delivery, but that's just not the case anymore. There has been so much more competition that has likely been eating away at its margins and certainly its dominance by some extremely well-capitalized players like a Walmart.
I would love to know, Dan, I'm sure they don't disclose this granularity, but how much of the business is Costco? Because previous to Instacart, you couldn't shop at Costco without a membership card, but now you can. And even as a Costco member myself, their delivery service, which is a little cheaper, is still powered by Instacart. So that feels like an important part of the sustainable demand for it.
Yeah, I don't know, obviously, what they're going to break out in the S1 in terms of customers, but they're not the only ones. If you, for example, go to Publix.com or Wegmans.com to do a delivery order, that's also being powered by Instacart. So Instacart kind of, there's the end user stuff that, you can open up their app and order from various stores. But also if you just go to a lot of stores directly, Instacart's still making the money off of that on the back end.
And would you both say, I mean, Deirdre, last word to you, that this, it felt like a week ago we were saying, arm schmarm, where's Instacart? And now here we are, and here it comes. So I guess that means, game on for the fall.
Game on, certainly. I think it's going to be really important, though, the next few weeks as we actually see ARM and Instacart list. I mean, let me end by just pointing to a part of the listings market that is not doing very well, and that is SPACs. I mean, I couldn't take my eyes off of Better.com yesterday or today. This is a venture-backed company that was pushed out against the odds and, essentially crashed more than 90% yesterday. So I don't know that we are certain that these are going to go off well.
Yeah.
So there's that to bring into it, but it will be important. These are obviously different businesses in different industries,
right.
But all of it taken together, it's caution. I don't know that it's a slam dunk.
No,
that
that's
the
true.
IPO window is going to open.
Better.com is in the worst possible part of the economy right now.
Yeah.
In the mortgage business.
But why did they go out?
Right, I'm sure we had the CEO on Squawk Box yesterday. I think it was just if the window's cracked open enough, they're gonna walk through it. I guess, Dan, the quick final comment on all of that would be, it's bad taste in everyone's mouth from SPACs. As Bob Pisani said, maybe we need to price things a little conservatively to make sure that we don't have some high-profile blow-ups out the door here.
I think that's true. One thing that's notable about Instacart, they've been wanting to go public for 2 years now, right? And they don't have a cash crunch, unlike how Better might have. Instacart didn't need the money per se. They've got a bunch on their books. So the fact that they're doing this basically means they're bankers, and granted, bankers are fee-generated optimists, but bankers are telling them this is the moment when the markets are finally ready for new issues.
All right. Thank you both. Really enjoyed it. Dan Primack and our Deirdre Bosa.